overall this year, equity has been stronger than we would have anticipated, mainly on the global side, and the rand has weakened more than we would have expected. So in a sense, that has created an opportunity. We have been able to reduce some of our equity exposure as we still expect some weakness going forward. Markets have rallied quite strongly. So we've taken some profit within the equity space. And the big positive of rising interest rates is that you have a defensive asset class that is now offering you a good return. While interest rates have gone up very quickly, and that creates some kind of challenges for growth, both locally and globally, from an investment point of view, it creates an opportunity to provide some defensiveness in our portfolio and still generate a good return. So in South Africa, in particular, you've seen interest rates move up sharply, inflation has moved down, and so that real return you can get from shorter dated rates has really improved. So we've used opportunity of strong markets to reduce the equity exposure in our funds and to increase the exposure to shorter dated fixed income instruments. So just creating a level of diversity, but also potential for return in the funds. Both asset allocation and manager selection are key sources of return, but are also both very difficult to get right. I think when we look at asset allocation, one can't think of it as having a crystal ball and predicting what's going to happen in the future. And we've just spoken about the surprises already that have happened this year. For us, asset allocation is about looking what value is on offer and then taking a long-term view on that. Manager selection is just as difficult, but it's critically important for us. Where we can find managers that can outperform, it adds to that return that you're getting from an asset class and ultimately feeds into the strategies and the ability to meet the objectives and the targets that we have for the different portfolios that we manage. So what are we trying to achieve with manager selection? We're ultimately trying to find people that have skill, that have conviction in how they're going to outperform any particular benchmark. But at the same time, we want managers to have the humility to know they can get it wrong. And that comes into your risk management of the portfolio. So we're trying to find managers that have the conviction and the ability to generate the outperformance, but at the same time, also manage that risk so that over time we have a consistent outperformance of the active building blocks that we use. I think this year has just shown how diversification is key. As I said earlier, South Africa has disappointed. We've had decent returns from our asset classes, but not as much as we would have expected, whereas the returns globally have been way, way stronger, not just boosted by a weaker currency, but actual, strong returns generated from the underlying asset classes, and in particular global equity. And that's just where diversification is incredibly important. So we have a lot of value on offer. South African asset classes have become cheaper. And in the face of the challenges I've spoken about, we've actually seen a level of resilience here that one would not have expected with the challenges that we faced. While there are challenges to global growth going forward, there is still a lot of value on offer in asset classes. In South Africa, bonds and equities have become cheaper. They still offer value. Despite the challenges we've seen here this year, we've still also seen a level of resilience in our economy. So we have backed the managers that we believe can navigate this environment, both in equities and in fixed income, to generate the returns that are needed. We've seen global equity rally very strongly over the last, say, 9 months. We think there's still an opportunity there, but it has become more expensive. And as we've said, we've used that as an opportunity to take some profit there and invest in asset classes where we see more value locally, and that has been within fixed income. So we are still positive that with the level of diversification and valuation we have on offer, that funds can still deliver to the expectations that investors have.